8:51 a.m. Pacific Standard Time. Date 2/23/2014. What do we have before us? We have before us the S&P 500 chart. And basically I'm going to clear the trend lines, and I want everyone to understand one thing, that this is the top. When we go back to calendar 2009, when 2008 had put the world on the back of their heels, we have had a complete rally. Here is the 2009 rally. Then we come back in 2010, we had a nice pullback, and we rallied up here to the 2011 high. And we did. And then we had a 5-month pullback right here to that support level, and then we rallied up to the high over here of 2012. Now, in 2012, we started out January with a big move in 2012. 3 months up, 2-month reversal. One of the things that I'm going to show is these monthly moving averages. Now listen, everybody. On March 1st, it will have been a total of 60 months where the stimuluses came in, where the FOMC meeting did their thing, and everybody was printing paper, and everybody was injecting stimuluses in the system called monetary policy around the world, was putting all of their juice into the market called QE 1, 2, and 3. And what I'm going to say is that this bull rally from 2009 up to 2013 is coming to an end. That means that the rest of this year for 2014, as you can see how it started out, 2013 right here was a resistance level 1 year ago in January. And we rallied all the way up. We had a pullback in May here. We had another pullback. But then when we got to the end of it, here's that monthly trend line. And this is a monthly 60-month analysis of the S&P. Now, having said that, there's one thing you must understand, that this bull is going to get weaker at the upper end of the resistance levels. So let's just start it out this way. Here was the January effect. 1850 was the monthly high for January. We have the monthly high, 1850, and that particular monthly low was 1770. Then we start out February, the month of February. We started out and we made another lower low in the month of February at 1737. That was the low. Then we had closed at 1782, and we ran back up to the high here of 1847 on the S&P 500. Now, one of the things that I have said before the year started was that we are going to have a big volatility change in the calendar year, as we are. One of the things that needs to be understood is the following, that the VIX, which is the fear indicator, we're going to take a look at that one here in a minute, and this was the fear indicator in the month of January. We rallied up in the VIX. We got to a high. When that high was put in, that was the low in the S&P. So we are all the way back down here. No one has any fear about the market right now because the fear indicator reached a high when we put on a low there. So at 1737 was the peak of that fear that was on this monthly chart over here in February, right there, 2014. Now, what I am going to do, I'm going to show it in the monthly format as well. This is that fear indicator in a monthly level. Now, the lower it is, I'm just going to take this time frame. Back in 1993 and 94, we were at extreme low levels there. I was there, I know. Okay? And for a long period of time, between 1993, 1994, 1995, 1996. In 1996, we peaked and markets put in a bottom in 1996 in the S&P. Then we had a big sell-off in 1998, and I was there. So these were the low levels of complacency, no fear, everybody's good, all the money's in, nothing can go wrong. Now, back in year 2008, this fear indicator looked just like this on that monthly level. When that fear shot to all-time highs above 80, that's when the S&P was putting in their all-time lows at 666. How about that? Plus some change. Now, when we go back over here, we've had other peaks of fear. In 2010, when fear was at its highest level, markets were what? At their lowest level. We peaked, we rallied, fear came in 2011. We had 4 months, we peaked 3 months up. We had a 1, 2, 3, 4 months of fear in 2011. That's what the fear says. Now, I'm going to show you right now on this monthly level. The 60-month process of the expansionary model is over at the end of this month. We started out in 2009, 5 years ago. What I will say to everyone right now around the world and to our other people is the following. We have been very, very complacent, but let us not forget that that monthly bar that was up here, and that's a major wall of resistance. This bar right here on this monthly level right here, that was a fear peak in 2012. Now, in 2014, the fear escalated up here to the highs, and now it's back down to the bottom. Having said that, that's when everyone feels that there is any fear. And you only have to understand one thing. We are at all-time lows here for this whole calendar year. And yes, there was a couple of times that we peaked and we had pullbacks. But let us not forget one thing I'm going to show you right now. We are up here at the all-time high, and the 60-month expansion is going to go away. We're going to start a new 12-month, 24, 36, 48, and 60 months looking out. Now here's the deal. On this monthly level, what the public will look at is this monthly MACD at 137.7. That's absurd. Not only that, we remain overbought within this 2-month beginning cycle of 14. We put the low right here at 1737, and now we've rallied 100 points. That's volatility in the S&P 500, which is exactly what you see. We will continue down this path throughout the calendar year of 2014. So that you need to understand we are now in the 6th year, starting of that bull expansion right over here. I'm going to go back and show it to you again. The years of 2000, we had put the markets in and they got slammed. 2003, we go to war with Iraq and all of that. We rallied up to the highs of 2007. Look at the expansionary model back in 1996. Look at the 2003 to the 2007 top, and bam, it gave it all away. That was your financial crises. 2009, we hit the bottom. Now listen, people, expansion 1, expansion number 2, and expansion number 3. Look, the world is a lot different today than it was then. And do not be fooled either. And do not be fooled about the fact that this has been the most hated rally in United States history. Why is it hated? Because people aren't in it. But let me tell you something. As we continue the new 60-month cycle at the end of February, this 2nd-month move will be complete. I will tell you one thing. Over the next 60, I'm going to blow up this part of the chart. There it is. I'm going to tell you one thing. That we will be range bound in volatility, and we're going to be able to make a lot of money in the S&P 500. And what am I going to show you? I'm going to show you the following. What I'm going to show my bigger traders is that in the period of the time that we made below, this was a 1740 call in the S&P for March regular, the monthly one, which is one more month out. When we sold down in the S&P to 1737 right here, that was the low of 1737 right here. That was the low of the 1740 call that got down to 30 or $44 for that month. It got down there. And now this is inflated call of the 1740. That's inflated call up here at $102. Now, the put side is the opposite, below the market. Here is a daily put side right here. Look, these contracts, when we had that monthly pullback to 1737, these put options went from $10.50 to $46. So that means that the put side had gotten inflated when we put in the bottom in this calendar month right here in February 3rd. Then now we put a bottom in the market and we rallied all the way back. Now, that's the 1740 put at all-time lows of $4.74. Now, historically speaking, we are going to be looking at other various calls below the puts below the market. I'm sorry. And here is an 1820. Now, let me just tell my bigger guys, those were $80 a contract. Yeah, they made a low right here. So when they made a low of $20, and yes, the put side made a high of $80. Now, my MMTs, this $1,800 put, which is roughly below the market of 1847 on what? This here. This is the counter trend. We're going to be looking at buying these intraday, and that's an $1,800 put for the next pullback on the S&P. We are also going to put in the $1,820 put that we know had a big breakout when we're at 1733. When we were at 1850, these rallied up, and then the S&P hit 1733, which was right here on this monthly move. Not only that, that is an 1820 put that we're going to look at buying. Remember, they got retail up here, $91 a contract, and we are going to look at getting this thing wholesale below $12. But remember that the monthly resistance level is right here, and this is the 2014 move right here. 1737 here. We've had over a 200 point, if you take the combined points, 100 points down and 100 points up in the S&P, that's over 100 points both ways. Now, when we go and we look at the $1,820 call right here, this is getting, remember, the call side of the market was inflated when we started out the new year up here. And look at that, this call, the 1820 call, was a great trade in the S&P. And we got confirmation now that the S&P is going to have both the bull and the bear side. Those contracts were $8.20. They ran to the high peak of $40. If you had 10 call contracts at $9 and you sold them at $30, you made $21,000 on 10 contracts. Now, these are getting inflated, and we are going to have a lot of volatility. So let me explain to people what happens over here. This is going into the month of March, where a spring rally could happen. And yes, each time that we closed right here on the monthly bar right here at exactly 1836 on a closing level. But the high level was 1847. and that was 1850. And we were right below that 10-month moving average. What I am going to say is that both the bull and the bear are going to be able to make a lot of money. And I'm going to show the 1850 call right here in this chart. The 1850, let's make sure, a March regular. Now, take a look at what it's done. Okay, and this is the call. Now remember, the call side got taken to the woodshed, and we were extremely overbought. And the calls on the S&P here were on this level on 115, they were $33 a contract. And they went down here to the low of $3. If you had 20 contracts for $8,000, you would have cashed them in up here at $21. That's the high of this contract. Now, this is the call. What we are going to show is what the 1850 put looks like. And it's currently in the money. And that put side is no longer inflated mathematically. Sorry, it was way up here at the high already. It was $119 a contract. That was for the bear. The bear had that. Now, check it out. They're getting deflated. And that price, the low, is $26. And January is traditionally a bull rally month. So, what we're going to say, though, is that between these 2 months so far, there's going to be a lot of volatility. And I will tell you now, for the remainder of the 10 months that remain, is this market has reached another all-time high like we did in '08. We called that big move down. I was there in year 2000. I was also buying the market up in 1996. 4 years up, look at here. 2003 bottom, what? Little over 4 years here. Look at here, though. We're starting the 6th year. And I can tell you right now, going out to 2015, 16, and 17, we are going to come all the way back down. Because you know why? I can tell you why. Economically, there isn't going to be any cheap money to go buy a car or to refinance a house. Interest rates are going to go higher. The unemployment is going to go back up. Why? Because there's all kinds of messes with the Obamacare. And there's other things too. I'm going to tell you, though, that not one of these moves have ever held up. Why? I just showed you the evidence. I showed you the evidence. They go bad. They go bad. Now, on the third one, because that bull is in the tape, and they're really in the tape. Oh, don't get me wrong. And over the next 12, 18 months, we're going to see a huge reversal as we move through this year. And not only that, the earnings expansion has been great as to what this was here. And earnings, and remember, corporate of America bought their own stock. Every quarterly report was a repurchase buyback program. So a lot of this rally in here was corporations buying back their stock. It helped move the prices. But let me tell you something. This rally here is about 171% from the low to the high, right here and right now. And we are going to have bear funds at certain times, and we're going to have bull funds. We'll have puts, we'll have calls. This thing is going to be much more volatile than it was in 2013. Here are both the legs that it happened. Reversal 2000. Reversal, we called that big move down in 2008. And now a longer rally between the last two. The next 60 months is going to be quite interesting in America because we do not have growth. No, we don't. GDP's at all-time lows for this market being here. Listen, this thing has been bought up by a lot of people, including hedge funds, including the company buying back the S&P 500 stocks. We had double-digit gains out of the 500 stocks in the S&P 423 in 2013 right here had double digits gains. That's not going to happen here now. Again, no, it's not. We have reached the peak for this short time, but let us not forget one thing. We can go up to 1950, or we can go up and really blow it off right around 2010 on that S&P 10 months out from now. But we're going to have a lot of volatility both ways. And we're going to be trading these contracts right here on the S&P index. They're all right here. There's going to be lots of move for both the bear and the bull. Just stay tuned. Once again, we have an overbought S&P. It's 171% off of the 2009 low. With that expansion modding coming to an end. And if I were you, I would stay tuned over the next 5 years right here and now. Because why? We don't want to see you get put into the next Armageddon. Listen, we're about as overbought as you can be. And when you got overbought in these technical indicators over here, you went down. Remember, it's a monthly chart. And it's a yearly pattern from the 2009 lows. Yes, it is. It's started here. And here we are. And over the next 12 to 18 months, there's going to be a big pullback. And once again, we're going to have a 10% pullback this year. It's been well over a couple of years that this market has even had a good 10% pullback. I'm going to take the 2011 scenario. When we got the lows here, we have not had that, and that is coming.